Since the end of World War II, Japan and the United States have maintained a strong alliance, forged from the devastation caused by the atomic bombings of Hiroshima and Nagasaki. Over the decades, Japan evolved into one of the largest foreign holders of U.S. Treasury securities, traditionally second only to China. However, recent data reveals a significant reduction in Japan's holdings, with a 21% drop since 2020. Similarly, China, the second largest holder, has decreased its U.S. Treasury assets by 44% since 2013. In the past 3 months alone, Japan has liquidated $61 billion in U.S. Treasuries, while China reduced its holdings by $51.3 billion. These figures highlight a growing trend of U.S. debt sell-offs by both nations, raising critical questions about the future trajectory of U.S. economic policies, potential shifts in interest rates, and the dollar's role as the world's primary reserve currency. This shift occurs in the context of Donald Trump's recent re-election, with his foreign and economic strategies often unpredictable and focused on America first. The adjustments in the behavior of two major U.S. creditors could strain relations with Washington, potentially reshaping the global economic landscape. In this video, we will examine these significant developments, exploring their historical context, economic impact, and the broader strategic environment that may shape future interactions between the U.S., Japan, China, and the international marketplace. To begin, let's review the U.S.-Japan relationship over time. For over 2 centuries, Japan adhered to a strict isolationist policy, known as sakoku, which restricted foreign entry and prohibited Japanese citizens from leaving the country. This policy was intended to preserve Japan's social order, limit foreign influence, and maintain political stability under the Tokugawa shogunate. However, a turning point came in 1853, when Commodore Matthew C. Perry of the U.S. Navy sailed into Edo Bay, now Tokyo Bay, with a fleet of steam-powered vessels. The stark technological and military contrast between Perry's ships and Japan's traditional methods forced Japan to abandon its isolation. The Treaty of Kanagawa, signed in 1854, opened 2 Japanese ports to U.S. vessels, and set the stage for additional unequal treaties that granted extraterritorial rights to foreign nationals and imposed low tariffs on Japanese goods. Though these forced openings were initially humiliating for Japan's leadership, they ultimately spurred Japan's modernization. By the late 19th century, Japan had adopted Western political, economic, and technological models, particularly from the U.S., which played a key role in Japan's transformation into a modern state. The collapse of the Tokugawa shogunate in 1868 and the subsequent Meiji Restoration marked the beginning of Japan's rapid modernization, with American educational models, legal codes, and industrial techniques helping shape Japan's future. By the early 20th century, U.S.-Japan relations had become more cooperative, with Japan recognizing American territorial acquisitions in Hawaii and the Philippines, while the U.S. acknowledged Japan's interests in Korea. Despite competing imperial ambitions, both nations largely maintained a balance, working together during World War I when Japan joined the Allied side against Germany, capturing German territories in the Pacific and providing naval support. This period laid the foundation for Japan's rise as a regional power and its growing diplomatic and economic relationship with the U.S. However, tensions escalated as Japan expanded its imperial reach into Korea, Manchuria, and Southeast Asia, which conflicted with American trade and security interests. In response to Japan's aggression, the U.S. imposed escalating sanctions, cutting off critical supplies such as oil and steel. These sanctions pushed Japan into a dangerous decision, culminating in the surprise attack on Pearl Harbor on December 7, 1941. The attack led the U.S. to declare war, fully committing to the Allied effort in World War II. After years of brutal fighting, Japan surrendered on September 2, 1945, following the atomic bombings of Hiroshima and Nagasaki. Under the leadership of General Douglas MacArthur, the supreme commander for the Allied powers, the U.S. oversaw Japan's post-war occupation from 1945 to 1952. The American-led reforms were sweeping. A new constitution was introduced in 1947 that reduced the emperor to a symbolic figurehead, guaranteed human rights, and renounced war through Article 9. Land reforms redistributed property, diminishing the influence of wealthy landlords, while powerful industrial conglomerates were broken up to promote competition. Labor reforms empowered workers, and education reforms introduced American-style schooling and democratic values. These changes not only democratized Japan, but laid the foundation for stable political institutions and set the stage for Japan's post-war economic miracle. The 1951 Treaty of San Francisco officially ended the Allied occupation, restoring Japan's sovereignty, but the U.S. remained heavily involved in Japan's security. The same year, the U.S.-Japan Treaty of Mutual Cooperation and Security was signed, allowing U.S. forces to remain stationed in Japan to ensure its defense. This arrangement enabled Japan to focus its resources on rebuilding its infrastructure and economy. In the 1950s and 1960s, Japan utilized advanced manufacturing techniques, quality control, and a highly educated workforce to achieve unprecedented economic growth. The U.S. served as a crucial export market, fueling Japan's ascent as one of the world's leading industrial powers. This synergy, U.S. security support combined with Japan's economic dynamism, solidified the U.S. Japan alliance as a cornerstone of post-war prosperity and stability. During the Cold War period, the strategic importance of the U.S. Japan alliance became a cornerstone of America's broader geopolitical framework in Asia. Situated strategically near both the Soviet Union and China, Japan's role in this context extended far beyond economic ties. Its geographical positioning made it a vital partner in containing the spread of communism across the region, providing essential logistical support, and offering military bases for U.S. forces. Throughout the Cold War, Japan was integral in supporting U.S. operations, with its involvement in the Korean War, 1950 to 1953, standing out as a key example. During this conflict, Japan supplied materials and services that not only bolstered the Allied war effort, but also played a critical role in stimulating Japan's own economic growth. The relationship between Japan and the United States further solidified during the Vietnam War in the 1960s and 1970s. Japan's strategic location and its consistent role as a reliable supplier of goods and services were crucial to maintaining America's presence in the Asia-Pacific region. While occasional tensions emerged due to issues such as trade imbalances and the U.S. military footprint in Japan, the core of the alliance remained robust. The U.S. security guarantee allowed Japan to focus on economic development and modernization, while Japan's rapid economic rise and its openness to American cultural and commercial influence helped reinforce broader U.S. strategies in the Pacific. As the global landscape evolved following the Cold War, the U.S.-Japan alliance adapted to address emerging security and geopolitical challenges. The dissolution of the Soviet Union shifted focus toward new threats, notably North Korea's nuclear and missile programs, the rise of China as a global economic and military power, and non-traditional security challenges like terrorism and cyber attacks. In response, Japan began to take on a more assertive security role. By 2015, Japan had reinterpreted its pacifist constitution to allow for collective self-defense, enabling the Japanese self-defense forces to work more closely with U.S. military forces and other regional partners on peacekeeping operations, maritime security, and humanitarian missions. Today, the U.S.-Japan partnership transcends traditional security matters, encompassing cooperation in fields like cybersecurity, space exploration, joint research and development, and addressing global challenges such as climate change and pandemics. The alliance has expanded to include multilateral frameworks like the Quadrilateral Security Dialogue, Quad, which brings together the United States, Japan, Australia, and India to strengthen the rules-based order in the Indo-Pacific region. This deepened partnership is not merely about safeguarding shared security interests. It also reflects a mutual commitment to upholding democratic values, the rule of law, and free trade, principles that aim to foster a more secure, prosperous, and stable future for the region and beyond. Turning to the financial sphere, China's holdings of U.S. Treasury securities have fluctuated over the years, reflecting the dynamic nature of global economic and geopolitical conditions. In the early 2000s, China began rapidly accumulating U.S. Treasuries as its trade surplus with the U.S. grew. By November 2000, China held about $58.9 billion in these securities. This accumulation was driven by China's need to manage its currency and bolster its foreign exchange reserves. Over the next decade, China's holdings soared, peaking at $1.367 trillion in November 2013, making it the largest foreign holder of U.S. debt at the time. These vast reserves were critical in stabilizing China's economy, ensuring liquidity, and fostering steady economic growth. However, from 2014 to 2024, China's U.S. Treasury holdings began to decline gradually. By September 2024, China's holdings had contracted to $731 billion. This shift was part of China's broader strategy of diversification, as the country sought to mitigate risks associated with over-reliance on U.S. debt. Several factors contributed to this reduction, including ongoing trade and technological tensions with the U.S., as well as China's emphasis on boosting domestic consumption to reduce its vulnerability to external economic shocks. Despite these cutbacks, China remains one of the largest foreign holders of U.S. Treasury securities, second only to Japan. As of April 2024, Japan held approximately $1.15 trillion in U.S. Treasuries. The reduction in China's holdings and the diversification of its foreign reserves have important implications for both U.S. debt financing and broader bilateral economic relations. These changes signal China's efforts to adapt to evolving economic conditions and reduce its exposure to potential risks in the U.S. Treasury market. In 2024, both Japan and China made significant reductions in their U.S. Treasury holdings, likely in response to market conditions and shifting economic strategies. According to the U.S. Treasury Department, Japan sold a record $61.9 billion of U.S. bonds in the 3 months ending September 30, 2024, while China offloaded $51.3 billion in the same period. These sell-offs occurred as bond markets were reacting to a range of factors, including concerns over potential inflationary pressures following U.S. political developments, particularly the presidential election and the fiscal policies of the incoming administration. The reduction in U.S. Treasury holdings by these two major foreign creditors could have significant ramifications for the U.S. economy. A large-scale liquidation of Treasuries could flood the market, depressing bond prices and driving yields higher. This, in turn, would raise borrowing costs for the U.S. government, businesses, and consumers, potentially slowing economic growth. A reduction in demand for U.S. Treasuries could also weaken the U.S. dollar, which might make U.S. exports more competitive, but also raise import prices, contributing to domestic inflation. This scenario could create broader market volatility and raise concerns about the sustainability of U.S. fiscal health. These trends underscore the complex interplay of fiscal, economic, and geopolitical factors shaping the U.S. economy in the years ahead. A decline in foreign investment in U.S. debt could lead to higher interest rates, making it more costly for the U.S. government to finance tax cuts, infrastructure projects, and other fiscal initiatives. Higher borrowing costs could also prompt the Federal Reserve to tighten monetary policy, which would dampen economic expansion. While a weaker dollar could benefit U.S. exports, it comes with the risk of inflationary trade-offs, complicating U.S. efforts to maintain economic stability. Moreover, Japan and China's strategies regarding U.S. Treasuries may be influenced by the broader U.S. trade stance. Protectionist policies, such as high tariffs and low taxes, could provoke retaliation from these countries, altering global trade flows and complicating U.S. foreign policy objectives. Ultimately, the evolving relationship between the U.S., Japan, and China will have profound implications for global financial markets and economic policy, requiring careful navigation of emerging uncertainties and challenges.